I mean, how the market is reacting is the old-fashioned kind of good news is bad news approach. So for a while, good news was being treated as good news, but now we've flipped back. And I think what the market recognizes is that the Fed has a very short window now to act before they start running up into the US election. And as that window shortens, there's less that they can do in terms of relaxing monetary policy, and there's more chance that things will break. And I think that's the dynamic that's playing out.
So which do you see happening more then at this stage? Is it going to be that bumpy ride for disinflation happening continuously, or is it perhaps reinflation as we've seen over the last month or 2 months or so?
Yeah, we still think it's a bumpy ride. We still think the trajectory is downhill, but there are more and more speed bumps, whatever you want to call them, in the road. And some of them look like they're going to take a longer time to come down from than we would have hoped. So it feels like a bumpy ride still, but in the right direction. But as I say, that window keeps closing.
Our viewers, incredibly smart, wealthy bunch. They want to know what the next trade is. So just give them an idea of what they should be doing.
I think there's a couple of upside surprises out there. One of them could be China. You know, we see from our flow data that investors are universally bearish on China. If this GDP print gets sustained, if growth looks like it's picking up, then China could be a big upside surprise. And in the US, it could be small caps, which again have been beaten up. And if we see kind of retail sales perpetuate.
Small caps. Now, as a premise for my question there, small caps are more cyclical than some of the big caps. Historically, one would look at the cyclicality of them as well. Interest rates are staying higher for longer in the States as well. Bit of a bold bet on the Russell and the broader market, isn't it?
Yeah, like I say, I mean, they've been beaten up hugely. They're obviously more domestically focused, which I think is important. And if we see what's happening in the US, it's a domestic economic growth story led by fiscal stimulus. So I think that could be an interesting play as well.
Yeah, this is a question we've asked a while ago now as well. And I still wonder about it. And I'm not sure if I've gotten to understand all the answers. So I'll ask you, Altaf, why is nothing actually broken out of the United States? I mean, you know, you're still sitting at these high interest rates. And it's high for longer, right? Maybe not necessarily higher because it's not moving any further. But just why?
I mean, I think it's, you know, the traditional transmission policy mechanism has broken or doesn't work as well because of a couple of things. Consumers whose biggest asset, biggest liability is a mortgage, as house prices and mortgages, they are fixed for longer term in the US at very low rates, which they managed to secure around COVID. Similarly for corporations, they've been able to roll over their debt, again, at lower rates. The problem is, if rates stay at this level until, say, 2025, when a big wall of refinancing is due, then I think we will start to see more things break. But for now, consumers and corporates aren't feeling the pinch of higher interest rates.